Welcome back, students. In the previous video clip, we discussed about, we practiced how to create internal operating schedules along with cost of goods sold, and then the ending inventory. Finally, we got the ending inventory at the end of December. And then that ending inventory will be linking to the inventories on the balance sheet as of December 31st. Again, the purpose of this exercise is to create a financial statement of a new venture. We have the initial balance sheet as of June 30, and then the income statement after 6 months period ending December 31st. And then we have the operating schedules. Using all the information, we'll create the balance sheet year end as of December 31st. And then using these two balance sheet, initial balance sheet and ending balance sheet, we'll create the cash flow to get the cash build or cash burn and time to out of cash. And then we'll also analyze cash flow from operating activities, investing activities, and the financing activities. Okay, let's go. Here, the financial statement, the balance sheet, we are given that information. Venture has maintained $1,000 balance in checking account. So just simply 1,000. Accounts receivable, the credit sales, the 50,000, in December are the year-end receivable. Okay, also the given, the 50,000. I think we have some kind of insight, some the clues here. The accounts receivable is actually sales on credit, but it's not yet cash, right? So it has some problem of the conversion, the cash cycle. That's why we need to know why the operating activities, the cash flow is different from net income. Now inventory here, yeah, there you go, in the internal controller. So we simply link this. And then the sum of total current asset is 77,000. Again, internal control, the schedule, the operating schedule, internal operating schedules is really important because that is actual kind of evidence that the company has been planning how many goods or how much services will be provided in the near future, like 3 months or 6 months, or at least the year, every month. Property, plant, equipment has not changed yet, right? So we just link from the initial balance sheet. Let's accumulate depreciation. Do we have depreciation expense? Yes, we have the depreciation expense. There you go. On the income statement, we recognized for six months, right? So net property, plant, and equipment after the accumulated depreciation subtraction, and then we got it. We don't have any building or long-term asset yet. Accounts payable. Where do you get the accounts payable? Accounts payable have information. There you go. Year-end payable amounted to 15,000 from the credit purchase in early December to produce 300 the product. There you go. In order to produce 300, this 12,000 and 1,500 and 1,500 plastic pallets assembly parts, except for these 500 direct labors, because the accounts payable is the purchase, right? Raw material or parts or some product purchased from the vendor on credit, right? So this has 15,000 as indicated on the description. Accrued expense also, we have assumption here. How much is that? 3,000 had been earned but not paid yet, right? Therefore represent the year-end accrued wages balance. So accrued expense also liability until the payment based on accruals. Here, line of credit is one of the big the borrowing tools. But here the question is what would have happened to pass if its founder had at least of $25,000 of personally guaranteed debt. Okay, so the company might need the line of credit, right? Will make sure that if total asset is equal to total liabilities and equity, if the total liabilities and equity is below from this below the 96,000, the company needs a line of credit definitely, right? Okay, let's complete this one first. Long-term debts. The long-term debts, there's no other information long-term debts since the beginning, right? So nothing has changed it. Capital lease, also nothing has changed it. So total non-current liability is the sum of this. The common stock, based on that information, has not changed it. But the retained earning, what is the retained earning? Retained earning is the cumulative net income, net losses from the start of the company business. So all the net income, all the net loss, every period, it should be accumulated into the retained earning, right? So here, retained earning is exactly just the net income because the business just started and they start making profit, the net income, right? So the 3,000 retained earnings. So the total, the owner's equity is 43,000, right? We found that we need some additional line of credit, right? Oh, wait a minute. This should be sum of all the current liabilities. Okay, there you go. So how do we get this line of credit, right? All the assets should be equal to total liability and equity. Why? Why asset is equal to the liability and equity? Because when the company starts their business, all the money sources, all the asset sources came from liability and equities, right? So that's why the liabilities, equities, how much the company owe, and then asset is how much company own from this money borrowed by the liability and equity. So the line of credit to match the asset is equal to liability and equity. This 96 total asset minus all the liabilities, right? The liabilities. Oops, we can just put simply this is sum. Then we match this total asset and total liabilities and equity, right? So the line of credit, the company definitely should borrow 25,000 because they run out of the cash they need to this, the line of credit to match the liability and equity and total assets. For the cash flow statement, we'll continue in the next video clip. Bye-bye.